Welcome back to Closing Bell. Big tech getting crushed in today's market sell-off. Value investor Dan Niles from Alpha One Capital Partners joins us now on the phone. Dan, thanks for joining us. It wasn't that long ago. It was back in June that you were on Squawk Alley talking about the fact that you had renewed interest, renewed love for the semiconductor stocks. Where do you stand on those now?
Yeah, I think, if you look at what we talked about on our most recent interview with you, back in early August, our view was that this round of tariffs, et cetera, that we're looking at and the slowdown in demand would be pretty negative for semiconductor stocks. So they've obviously had a great run since that period of time, but, the epicenter of these tariffs affects hardware-related names, and in particular, this last round of tariffs, if they go through on September 1st, that affects cell phones, PCs, laptops. Those did not have tariffs before, and that obviously has a lot of semiconductor components going into that. So I think, for the semiconductor space from here, it's great. Everybody has optimism that the space is going to bounce, but you also have to remember those stocks are up a lot year to date. They're up 25% year to date, in fact, and that's up more than the S&P up 15. So I think that's one of the spaces you actually want to be very careful of from here going forward.
Dan, just talking about broader markets and the sell-off we've just seen again today. On August 8th last week, which I think was Thursday, you tweeted, I expected a short-term bounce, but 3.3% in 3 days. Wow. So do you think we had bounce late last week too much and that today's sell-off was worthy? How much more of a sell-off is due?
Yeah, you sort of left off the next sentence in that tweet, which was it's under at Daniel T. Niles, but it says, seems to Bobby McFerrin-like, right? And so the song is Don't Worry, Be Happy. And unfortunately, a lot of investors have sort of taken that view of, well, the Fed's going to save us, and so don't worry about it, and stocks are going up, so they'll go up more. And that's a really dangerous thing. And so I think to your question, which is the right one, if you think about where we are today, we've got tariffs coming in potentially on September 1st. Then China devalued the yuan. And then, there was the U.S. government's not going to buy from Huawei. And so things are not getting better. They're escalating. And then on top of that, you've got protests in Hong Kong obviously going on. You've talked about the situation in Italy. There's a lot of things that are pretty negative. But you look at the stock market, and if you were, sort of come from a different planet, you go, wow, the Nasdaq's up 19% for the year, the S&P's up 15% for the year, and the semiconductor index is up 25%. Things look great, but that's not what's going on fundamentally. The only thing that's good is the Fed is cutting. But, as I said in a prior tweet, they're cutting for a reason, and you need to be aware of that, and it feels like investors have just gotten too complacent. So, yeah, I do worry there's a lot more downside from here.
So then, Dan, is it the big cap tech names, the software names that maybe don't have as much exposure to China, for example, that continue to look the most attractive?
That's a great insight, Morgan. Yeah, that's exactly it. What you want to do is you want to avoid the names that are associated with China and forget about the fact that the charts look good. So as you pointed out, if you look at a lot of the software names, they're not in China. You look at the big internet names, Google and Facebook, they're locked out of China. And so those are the areas you want to go to when you're looking for things that make sense, or look for names that are beaten up, but where fundamentals are starting to improve, like in some of the gaming stocks. So those are the areas that we're more focused on right now in terms of looking for longs and adding to exposure.
Facebook and Google both down over 1% today. Have you added to exposure today? Will you be doing so tomorrow?
Yeah, we didn't add any today, to be clear, but during the sell-off we were. That happened, a week ago. And yeah, we are actually, that's our next move, is to try to find levels where we think, okay, we can add some more to them, because as Morgan pointed out, right, a lot of these stocks, they don't have exposure to China, so we're happy getting longer those names and then shorting more in the hardware space where, you asked that first question on semiconductors, areas where we think they're in the epicenter of the new tariffs coming in. And so that's how we're trying to manage our risk at this point. And the hedge fund that we run, it's sitting on some cash right now because, we've been worried about a sell-off. Obviously, you referred to the tweet I put out earlier. And so, we're trying to be very careful with how we buy stocks and at what prices we buy them.
So whether it's a name like Facebook or some of these other big tech names, or the video game stocks, for example, regulatory risks, something for the market to shrug off here?
Well, I mean, you shouldn't be shrugging off. You should be certainly paying attention to it. But, as we saw, I mean, we've seen this before, right? It took a long time for Microsoft to get through that. We're talking years before anything happens with Facebook or Google or Amazon or with the video game company. So the headline risk, in my opinion, is a short-term positive because, you can't wake up. I mean, how many days is it before you have something negative that comes across on Facebook or Google on privacy or Amazon on anti-monopoly or on EA or on somebody's, something bad happened and so it's video games' fault. There's lots of negative headlines that go across for all of these names, which thankfully has kept the expectations pretty low. But if you look at Google and Facebook, business accelerated last quarter despite all the headlines. So, that's a good sign that despite all of this, the business continues to do pretty well despite what the politicians are saying. And so I'd rather be in names like that than stuff that's overhyped, because you look at some of the software names that have no earnings and that have sky-high valuations trading at 50 to 20 times sales, I want absolutely no part of those names. Because if something goes wrong and the economy softens, which is obviously what the bond market is telling you, those stocks can go down and get cut in half and still be expensive, and they have no earnings or cash flow. So that's where you should be really scared. The charts look great, which is wonderful, but, that's about the best thing right now, because from a risk-reward basis, there's a fair bit of risk with where they're trading.
Mm-hmm. Dan, great to speak as always. Thanks for joining us.
Thank you very much, Wilfred.
Let's bring in Jim Paulsen, Chief Investment Strategist at the Luthor Group, and on the phone, David Rosenberg, Chief Economist and Strategist at Gluskin Sheff. A very good afternoon to you both. David, if I start with you, this big sell-off, buying a bond, selling, fall in the yields of bonds we've seen once again today, where do you see it going from here?
Well, in terms of the stock market, we are just at this point, after having broken below the 50 and 100-day trend lines, we're just 3% away now from 27.93. That's the number that if you're bullish, you hope holds, because that's a 200-day moving average. And I talk about this because this has largely been more of a technically driven market anyways, as opposed to strictly fundamentals. So pay attention to the technicals. And, again, if you believe that this bull market is ongoing, that 200-day trend line has actually completely flatlined right now. And as for bonds, this is really the mother of all short covering rallies. We went into the month with the net speculative short position on the board of trade at 363,000 net shorts, and they're hurting right now. So this is probably going to continue, whether you believe the fundamentals or not. There's a very strong fund flow impact happening in the board of trade in terms of these massive levels of shorts being forced to cover right now.
Jim, what's your take on market action? We've seen the pullback in stocks in the past week, and also just the rally, today excluded. Are you still as constructive as you were the last time we spoke, where equity markets are concerned?
I still am, Morgan. I mean, I think I look at this. I could be wrong. There's no doubt about that. But I look at it more as a correction along the way. And David's right. We're playing some technical levels here with that correction. We've got some lows that maybe we need to retest. I don't know. But I just think if I look out over the next six months or a year, I think there's good opportunities here. What I believe is we're overplaying the negative impact of trade and underplaying how much stimulus we've dumped on this global economy, and not just the Fed cutting rates. They were the last animal in the world to ease. We've dramatically eased rates now, 160 basis points in the 10-year in this country. We've expanded the real money supply from 1% late last year to over 3% now. With the deficit as a percent of GDP has gone up a full percentage point in the last year. We've got three-pronged stimulus that you normally only see when you're trying to get out of a recession. And year to date, we're growing at 2.6% on GDP, which is actually above average during this expansion. I think with the lag effect of policy, which is we're just starting to enter that appropriate lag time, somewhere around 9 months or so, and I think that's going to work, and economic growth is going to pick up here. You're already seeing the Citigroup economic surprise indices in the United States pick up in the last 4 to 6 weeks. They've picked up in the emerging markets. They picked up in Japan. I think we're already starting to see a turn a little bit in momentum. And if that happens, then I think the imminent recession fears fade, and there's probably pretty good upside that will start from like a 160 10-year. Quite a bit of room, I think, when you look at average P's against a very low base. So I'd look at adding a little exposure. My three favorites are emerging markets, technology here. I'd stay with that. It's one of the populars, but I'd stay with it. And then I'd look at financials because I think rates are going to go up over the course.
David, you disagree. You don't think the Fed easing is going to deliver the type of stimulus that's needed at this stage of the cycle?
Yeah, it's called pushing on a string, and we've already got the template because the bond market did so much heavy lifting as it was over the course of the past 10 months with the 10-year note yield coming down 150 basis points, and the housing market and auto sales barely have a pulse. And that attests to the fact that the private sector in the United States is just choking on a level of debt, and we're not going to see the big impact in aggregate demand. And even if we do, the lags between what the Fed does now is not going to be felt for 12 to 24 months down the road. You know, the point I'm making about someone like Jim can focus on the surprise indicators. That's fine. You can drive looking through the rearview mirror if that's what you want to do. The OECD leading indicator came out last week, and it's declined 18 months in a row, and it's actually down to its lowest level since 2009. The U.S. leading indicator from the OECD down 12 months in a row. That's looking through the front window, and things are cooling off and are going to continue to cool off, and the bond market's telling you that. We have 3 basis points. The 10-year tip yield is 3 basis points. What's that telling you about economic growth? If we're going to see a strong economy, we'd be seeing inflationary pressures going up. Instead, look at what the CRB Metals Index did today. It collapsed by more than 1%. And look at the 10-year tips at 161. They were 175 the day of the Fed meeting. The Fed is really behind the curve right now. That's the message from the bond market, seriously behind the curve.
Gents, we have to leave it there, but we thank you both for your opposing views and look forward to having you both back again soon.